Well, good day to all of you. Today we're going to look very quickly at chapters 10, 11, and 12 on valuation, cost of capital, and capital budgeting. We're going to look at what the value of a financial asset is, and all of this keys on the time value of money, that information that you've acquired in chapter 9. That's pretty important. Dig into it. Keep working at it. Chapter 9, time value of money. Okay, what is the value of financial asset? Well, quite simply, in the terms of time value of money, the value of financial asset is the present value of the future cash flows. Remember that. The value of a financial asset is the present value of the future cash flows. That's what you're going to pay for it. That's what you pay for when you buy a stock. That's what you pay for when you buy real estate. That's what you pay for anytime you're buying something that has financial value, is you're paying the present value of the future cash flows. And if you can figure that out, then you can determine, hey, what is it worth? Okay, here we go. Let's look at chapter 10 real quick and see what we can find out about valuing a couple of assets. We're going to look at bonds and we're going to look at common stock. And they both use the present value computation. First of all, a bond is a loan. If somebody loans me money, I give them my bond that I'll pay them back. And in business, a bond is generally a loan of a large sum of money, usually in $1,000 increments or denominations for each bond. And then at some time in the future when the bond matures, that principal gets paid back. However, during the interim, there is a coupon payment that is equal to the coupon rate or the interest rate that the bond was based on. Okay? So the value of a bond is the present value of its future cash flows, which include the principal, which is going to get paid back at some maturity time, at some coupon rate. Let's just call that the interest. Plus, I have these coupon payments, which is the interest. Coupon, okay, and those get paid every period. Usually bonds are paid every 6 months. We're going to simplify this and call it an every 1 year payment of the coupon. Okay, so the present value of the principal and the present value of a coupon. So here's a very quick example. Let's say I offer a $1,000 bond. That's the principal. And let's say it's going to mature in 10 years. That's the maturity date. Okay? And let's say it's going to pay a coupon of 6%. Okay? Now what does that mean? That means that in 10 years I get $10,000. I get $1,000 back. But every year I'm going to get 6% of that $1,000 as interest. Okay? And that will be the value of the bond. Now, bonds get a little tricky because there's something called the yield, which is determined by the market. As you know, the interest rate can change from month to month, year to year, but the yield is the key element here. Okay, and yield is what we really don't know, but we'll just make a guess on what the market yield might be for this bond. So the value of this bond is going to equal to the present value of the principal in 10 years. Well, that's the present value of $1,000 times the present value interest factor for 10 years at whatever the yield is. And let's say the market yield now is 8%. And I can look that up on my tables, right? Present value interest factor, $1,000. What's $1,000 in 10 years worth at 8%? Well, I don't know. You look it up, and it's easy to figure. Plus the value of the coupon. The coupon is a 6% coupon, 6% of $1,000, or that's $60 paid every year. That's an annuity, a regular payment every period over a span of time, times the present value interest factor of the annuity for 10 years at, and we again have to use the market yield of 8%. Well, you just go through, you get the numbers off your tables, plug it in, add it up, and you'll find out what that bond is worth today. Now, we're not going to compute that. I'll let you do that because it's pretty straightforward. But the important thing to recognize is, as the yield goes up, the price of the bond goes down. That's the so-called inverse relationship between interest rate and value of a bond. Okay, that's enough for bonds. Remember, principal, maturity, coupon, market yield. The yield is a market-based thing. The coupon is a structure of the bond thing. Okay, and it gets fixed once those bonds are issued. The yield can cause the price of the bond to go up or down depending on what the market yield may do. Now, let's look at common stock. Common stock. Now, in chapter 10, you've got this nice little equation that comes up that says the price of a common stock today is equal to the dividend that will be paid next, D sub 1, okay, divided by the required yield of that stock less the growth rate of the dividend. Now you can see that in the PowerPoint for chapter 10. But let's take a real quick look at what these various things are. First of all, K sub E. K sub E is the required yield for the stock. And again, it's a market-based thing. It's what the investors expect to receive for that stock. Well, there's a pretty interesting thing that comes into play about that, and I think you run across that in chapter 11, and it's called the Capital Asset Pricing Model, or CAP-M. Capital Asset Pricing Model gives us a required yield that an investor wants to have for the stock. And that is equal to the risk-free rate. In other words, the rate generally assumed to be for the midterm U.S. Treasury notes, 3-month Treasury notes, and whatever yield that is considered risk-free. There's still a thought throughout the world that investing in America is pretty darn secure and safe, plus something called beta, and I'll show you how to get that in a moment, times the market return, the return of the market, and that's what the overall stock market is doing, and that's the market premium above the risk-free rate. Okay, and that's shown in chapter 11's PowerPoint. Now, what is this beta? Beta is a statistical measure about how a particular stock varies relative to the market. Okay, now, what I have here is I went to Value Line and I pulled off the Value Line sheet for Verizon Communications. See that? Now, I don't know if it's focused or not, but you can take a look at that. And we're going to take a look at how we get these various items here. Now, first of all, looking in the upper left-hand corner, you'll see the ratings, timeliness, safety, technical, and underneath that is something called beta. That's that beta. And for Verizon, the beta is shown as 0.7. So we're going to look at Verizon Communications has a beta of 0.7. Okay? Now, with that beta and making some assumptions that we're going to make, first of all, I'm going to assume that the risk-free rate, is equal to 5%. I'm going to assume that the market rate is equal to 8%. And we get those by looking at overall performance of the market and what the treasuries are doing these days. So if I plug all these values in here, I find that the required return for Verizon is equal to 5% plus 0.7 times 8 minus 5 equals, computing all that out, I get 8.5%. That is K sub E for Verizon. Okay? Pretty simple, right? Pretty straightforward. K sub E for Verizon. Okay? So let me write that here. K sub E equals 0.085. Okay. Now the next challenge is getting G. What is G? G is the growth rate of the dividend. Again, get this value line sheet for Verizon. And down here on about the fourth line down, it gives the dividends declared per share. See that? Dividends declared per share. Pretty good. And with that, I'm going to pick 2 points, 2004 and 2009, and that's a 5-year span, So the dividend for 2004, I get off the sheet as $1.54, and the dividend for 2009 is $1.87. Well, that's growth. How do I figure out the growth? Well, I use my time value of money computation, and I say that a present value of $1.54 has to grow to $1.87 at some present value interest factor, okay, it's a lump sum, for 5 years at some percent X. And we've had examples about how to do that when we did problems 44 and 45 out of chapter 9. I just take that, divide it together, find out what the present value interest factor is, and we'll get up on the table and figure out what the value is. Now, folks, I like to use a financial calculator. I recommend you get one. If you're going to be playing this MBA game, you need to figure out a financial calculator. I recommend the Texas Instruments BA2 Plus. The instruction manual is something to hang on to because it gives you step-by-step ways to figure out how to do things. So anyway, I used that and I determined that the dividend growth rate for Verizon stock, G, was 3.4%. So I got G equals 3.4%. Okay. Next step, and I've got just a little over 2 minutes to wrap this one up. So let me get scooting here. Okay, the next thing I got to do is have D1. Well, I know that D0 in 2009 was $1.87. D1 is the next dividend. So that is this D1 is equal to D0 times 1 plus G. The dividend grows by the rate G, or 3.4%, equals $1.87 times 1.034, and I get that. Well, I didn't compute that actual value because we're just going to stick all that up in here in our equation. Okay, so let's do that. Let's stick it all in our equation. The price of the stock, D1, which is $1.87 times 1.034, that's the most recent dividend growing by 3.4%, divided by 0.085 minus 0.034. Okay, I have to use the decimals here, folks. And when I compute that, I get a share price for Verizon stock of $37.91. And you know what? That's real close to the market value of Verizon stock. Recent price shown on Value Line as of near the end of December was about $34.67. It's pretty close. It doesn't capture all the factors of the market, but it captures the big things. And then you, the investor, get to determine, hey, is there a premium in the price? If there's a premium, why is that premium there? Well, this is real quick through chapter 10. When I started, I said we'd get to chapter 11. Maybe I'll give a little video for chapter 11. But this is chapter 10. On your mark, get set, go.